Could you take us through the investment strategy of UTI Multi Cap Fund and how do you approach investing across large, mid, and small cap companies?
So if we look at our strategy, first on the right-hand side, like I said, I mean, the category requirement is that you need to have about 25% exposure to large, 25 to mid, and 25 to small. The remaining 25% can be allocated anywhere. The way we have articulated is that the range for large caps can be 40 plus percent plus or minus 10%, while for mid and small caps, it could be 30% plus or minus 5%, which means large cap weight could be anywhere from 30 to 50%, while mid and small caps could be anywhere from 25 to 35%. But over a longer period of time, the average allocation could be around that 40, 30, 30 between large, mid, and small. Coming to the way we look at it, like I mentioned, from a style perspective, the market has alternating trend. Few years value does well, few years quality does well. So as far as multi-cap is concerned, it is a blend strategy where we have a good allocation to quality or growth companies, where these companies have high ROCEs or have higher growth than the nominal GDP or the overall markets. And obviously, they have higher valuations. But as long as the growth justifies or the ROC justifies those valuations, we tend to take them as part of our portfolio. And so on the other hand, value could be cyclical opportunities. These are companies which are low on price to book or price to earnings, EV/EBITDA, whichever metric. They could be lower because of lower growth or the cycle being against them. But as long as their long-term track record is good and they can deliver good, reasonable return ratios, those are also opportunities which we tend to identify. And on the extreme left, if we see there are a few transformation opportunities, it could be in quality, it could be in value. Time and again, a sector or a company could be going through stress. And when they come out of that, there is a lot of money to be made because they are cheaply valued when they are in stress. So those opportunities are few and far between, but wherever we have those opportunities, we would like to kind of grab them. So it's a good blend of quality and value, and as well as whenever the opportunity presents, some transformation or turnaround cases. So overall, it's a blend strategy, and the idea is to pick up companies across sectors, across market cap, wherever there is an opportunity of because of mispricing in the market, opportunity to create wealth. So it's a complete bottom-up approach, the way we look at constructing this portfolio. And market cap, as we discussed, it could have good exposure to large, mid, and small, and internal guardrails still kind of clearly provide us the construct as to sector weights and stock overweights and underweights. Based on that, the portfolio is constructed. And due to the nature, a large pool of companies to look at, the opportunities are a lot more, and to that extent, compared to our own other strategies, the portfolio turnover here could be higher. So in a gist, it is uniquely positioned compared to some of our other diversified categories because of the higher exposure to mid and small cap, and it's a disciplined strategy of following a blend as well as having a good allocation to all market capitalizations. And for this, we need a large research team because we would be tracking multiple companies or a very huge pool of companies beyond the NSE 500 or Nifty 500 as well. And for that, we clearly have one of the largest research team, experienced one at that as well. And this fund clearly provides portfolio diversification in every aspect, as we have discussed.
Karthik, commit to the current market environment, and particularly in the context of what Vetri spoke about earlier on the valuations and mid and small caps. Could you share some insights on the current portfolio positioning of UTI Multi Cap Fund and how you are navigating the opportunities in the market today?
So, from the portfolio perspective, we have over 70% active share. The category is such that you're trying to pick up around 70, 72 odd stocks from a pool of probably 700, 800 companies. Our own coverage is close to 500, 480 plus. And from that, we are selecting a handful of companies. So, to that extent, the active share tends to be very high. So we have over 70% active share here and well diversified one at that, so which you can see from the top 10 holdings, less than 30% in the top 10 holdings. So there is a strong middle layer of portfolio as well where there is reasonable weightage. From a market capitalization perspective, as we discussed, it is close to the average that we've talked about. Large caps around 37 odd percent, mid caps around 29%, and small caps about 34 odd percent. From our score alpha metrics perspective, compared to the benchmark, whether it is C1 or R1, slightly it is higher than the benchmark, so slightly tilted more towards quality at this point in time. But when you look at the valuations parameter, it is almost close to the benchmark. The benchmark on a price to book is 3.2. The fund is at 3. Even on a price to earnings basis, it is slightly lower than the benchmark. The return ratios measured in terms of ROE is almost the same. If we come to the portfolio itself, the left-hand side table shows the top 15 holdings. You would see a lot of financial services or banks there. The construct of the even the larger universe itself is financial heavy, and to that extent, you see a lot more financials here. Besides our own liking for some of these large private banks. On the right-hand side, you again see names which are not part of the Nifty 500, but reasonably sizable market caps and sizable businesses across sectors, right from capital goods, consumer durables, FMCG, and chemicals. If we go to the subsequent slide, so on the right-hand side, you see the sector weights. Financial services overall, it looks like an underweight because of our underweight in some of the mid-sized private banks, capital market companies, and NBFCs. But large private and insurance is something that we are clearly positive on. Besides that, healthcare is one space where both on the pharma as well as hospital diagnostic side, we are positive and we are overweight. And within consumer services is where we are overweight, while the consumer staples or FMCG is where we are underweight. On the left-hand side, you see the top 5 active weights or overweights. There are names in banks, capital goods, financial services, and similarly underweight also in similar sectors. Now, coming to the fund has been almost there over a year. In the last 1 year, if we see the allocation broadly for large cap has been around that 40% mark, and mid and small caps have been around that 30% mark. Even the latest month, the split is 36, 28, 32. From a number of stocks perspective, we've been around 70 odd, plus or minus 5 odd stocks there. So very well diversified in that. And like I explained, the top 10 stocks have less than 30% weight. So it is well diversified. Even the stocks beyond the top 10 also have reasonably good weight. And again, from a sector perspective, we are very well diversified, present in almost most of the sectors which are there in the benchmark. Active weights, like I mentioned, we have close to 70% on a stock level. Even on a sector level, if we look at it, is around 15 odd percent, which shows that at the sector level, we are trying to have good exposure across sectors and not taking very lopsided sector bits. So it's more stock picking bottom up basis, but across sectors, across market caps.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.